So let's take a look at two particular risks in the fixed income market: interest rate risk and embedded option risk. So interest rate risk is, well, it's the risk of interest rates moving up and down. Nothing too fancy about the terminology. But how it affects fixed income securities might not be very intuitive. So let's go through it and perhaps we can make it more intuitive. When you purchase a fixed coupon security, the return to maturity is known and based on the market price you pay. Okay, a little bit of an abstract comment. Let's bring it back to more common terms. What's a fixed coupon security? Well, it pays the same rate of interest for the life of that particular security, like a fixed rate loan. Okay? So in fact, let's think about this in terms of a loan. You take 1,000 of your hard-earned dollars, you lend it to some company for 10 years, and they promise to pay you a rate of interest. Let's call it 6% a year. And in fact, they're going to pay you that rate of interest in semi-annual or twice-a-year installments. So that would be $30 every 6 months, $60 a year. And the maturity on that particular loan is 10 years long. So you would expect every 6 months to get a check in the mail for $30. How many of those checks are you going to get? 20, right? 2 a year for 10 years. Well, what about the original amount of money, the $1,000, the principal that you lent? At the end of 10 years, you get another check in the mail for $1,000. Well, that's great. So you buy it for $1,000. You receive 20 payments over time for $30 each. And at the end of 10 years, you get your $1,000 back. Now, we don't really need a calculator to figure out our return on that investment. It's 6% on a semi-annual basis. Wonderful. So really what we're talking about with bonds is fancy words, coupon, or the maturity amount, the $1,000. We also call that the face value of the bond. Some people call it the corpus of the bond. Those are terms you might hear. It's just a cash flow. Money coming in, money going out. Now, the $1,000 that you invested in this loan, that would be the price of the bond. Now, I want you to pay attention here. The $1,000 that you invest might not always be $1,000. Sometimes it might be a little bit more. It might be $1,005, $1,010, $1,020. Sometimes it might be less. It might be $970. Could be $950. But the set of cash flows, the 30, 30, 30, 30, and the 1,000 in 10 years, those are fixed. Those stay the same. Well, gosh, let's think about this for a minute. If you paid or lent more than $1,000 and got $1,000 back, right, wouldn't you expect that your rate of return would be lower than if you paid $1,000 and got $1,000 back? Yeah, sure, right? Well, what if you paid, $950 or lent $950 and got back $1,000 plus the periodic interest payments? That extra $50 is kind of like a bonus. Well, that would increase your yield, wouldn't it? Right? Well, we've just explained in plain English this idea of the inverse relationship in bonds between prices and yields. Now let's go back to the interest rate risk points on our slide. Bond prices do move, and thus our yield to maturity changes inversely to price. That's kind of the textbook explanation of our previously common sense explanation. Now, if you decide to sell your bond prior to maturity, you may or may not sell that bond for the same price that you bought it. You'll sell at a new market price. And if that price is higher than the price at which you bought it, the new person will enjoy a yield to maturity that's slightly lower than yours. Good for you. That's a market price for them. Don't want to say bad. It's the market price for them. If you happen to sell that bond at a lower price than which you originally bought it, the person who buys it from you will enjoy a higher yield to maturity. Still, it's a market price for them, but not so good for you, because that lower price at which you sold it affects the holding period from the day you bought it, moving forward till today. It affects your yield on that holding period, and it'll tend to lower it. And that's what we're really summarizing in this second point, right? The sale at a yield to maturity lower than that which you originally purchased increases the yield for your holding period. right? Except we talked about it selling at a higher price. But if you sell a bond at a higher price, you're selling it at a lower yield. High price, low yield. A sale at a yield to maturity which is higher than that which you originally purchased necessitates that you sold it at a lower price, okay? And that's going to decrease your yield for the holding period and is going to result in a return below your anticipated yield or your original yield to maturity. So, what can we say about the fixed part about fixed income? Well, the fixed part really applies if you hold the bond all the way to maturity. Can we say that's a rule? Sure. Can we say there are exceptions to the rule? Yeah, we sure can. There's something called, an event called a bond being called. What does that mean? Well, let's take a look. You've probably borrowed money sometime in your life. It could be a credit card, auto loan, student loan, home equity loan, or mortgage. I would be very confident in saying that any single time you ever borrowed money, if you walked in with a bag full of cash to the lender, probably a bank, and said, I want to pay off my loan now, they would say okay. And how much of that loan would you have to pay off? Only the amount that you borrowed. If you borrowed $1,000, you'd pay off $1,000. Not 1,005 and not 970. Just 1,000. Who gets to make that decision about paying that loan off early? Well, actually, you do. Why would you do it? Well, for some reason, it must be to your advantage. So let's take a look at that here. A lot of times, borrowers have the option, i.e. their decision, the option to pay off their debts early without a penalty. Now, I will tell you, even on the consumer basis, if you read some loan documents, sometimes car documents, sometimes mortgage documents, there might be a penalty for paying off a loan early. They're kind of rare in the consumer world. But in the wholesale world and in the bond world, not so rare. Now, typically, this idea of paying off loans early in the bond world, it does apply to issuers of fixed income debt as well. In fact, until fairly recently, even the U.S. government, when they borrowed money in U.S. Treasury notes and bonds, those bonds, the government had the option of paying off those bonds early at a price of 100 cents on the dollar, even if that bond was trading at a price significantly higher before the government made that decision. Now, in the bond markets, we refer to this option of repaying the debt early as a call. That's the technical term for it. It's a call. And typically, bonds are called at a price of par. Here's another convention, another word to be familiar with. Par equals 100% of face value. Okay? We don't call it 100, we call it par. Well, what do you think we would call 1% under 100% of face value? We call that 99. What do we call 1% over 100% of face value? We call that 101. Well, what do we call that amount exactly in between 99 and 101? Go ahead, say it before I do. I hope you said par, because don't ever say 100 in the bond world. You have to learn how to speak the language. We're creatures of habit, and one of the habits is we never say 100. We only say par. Now, why would a borrower pay off the debt early? Because it's to their advantage to do so. What are some reasons in the corporate world or in the wholesale world? They might have a lot of excess cash, and they just don't feel like paying that rate of interest. They'd rather, instead of paying interest to outsiders, maybe they want to pay down debt, save that money themselves, pay it out in dividends to stockholders. Variety of reasons. It could be that they borrowed this money at a high interest rate, and now rates are lower, and they want to do the equivalent of a refinance. Now listen, you've absolutely read about this in the newspapers, and maybe you've done it yourself. You took out a mortgage some years ago. It was 8%. You get a letter in the mail from a bank, hey, you can refinance at 4%. You know, wow, you're paying some institution 8% a year, and you're making your payments, right, because you're a creditworthy person. You're paying them 8% a year, and that institution is collecting that money. What kind of institution? Could be a retirement fund, you know? It could be some pension, could be an insurance company, could be anything. But they're collecting that money at 8%, and because this bank sends you a letter and says, hey, you can refinance at 4%, you decide, I'm going to repay that loan at 8% at par. So that investor that was enjoying that fat, juicy 8% return per year, now they get nothing. Zero. Okay? I mean, they got their money back, but no more big return. And you go to a bank, you take out a new mortgage, it's 4%. The investor has to go buy some new fixed income security. Where are they in the marketplace? They're 4%. Huh, but we were getting 8. Now we get 4. It hurt. Well, that's what happens with calls. And also there can be extraordinary events in the corporate world. You could have business termination, acquisition, any number of things like that. But the overriding theme with calling bonds or paying off loans early is it good for the lender? Typically it's not. Typically it's not, okay? If it's good for the borrower, kind of in a zero-sum example, it's got to be probably not so good for the lender. Okay, because if it was a good performing loan, they were enjoying this high rate of return. Now you say, nope, sorry, can't get that anymore. Now remember that the right to exercise this call belongs to the borrower, the issuer of the bonds, not the person who invested in it. So the borrower is very careful to determine if it's to their advantage in calling this bond. And if it is, then it must not be to the advantage to the lender. Now, typically, can they call this bond whenever they want to? Well, you know, in the case of a mortgage or an auto loan, things like that, yes. You as the borrower, you can pay off your mortgage whenever you want to, or your auto loan or your credit card bills. You can do that. For the big companies that issue corporate bonds in large size and they want to get some institutional trading around that, they restrict their right to call that bond to certain periods. It could be once a year after the first 5 years. It could be at a 5-year point and a 10-year point and say a 15-year point, and that's it. Or it could be once in the bond's life. And all that is talked about in the prospectus or the paperwork of the bond offering. And it's important to understand. But always remember, those bonds are going to get called if it's good for the issuer, not for the investor. So what do? Well, we want to realize that there's this embedded option in the bond. Sometimes it's very clearly delineated as to what that option means. Sometimes, like in the case of a home mortgage, it's not. It could get paid off because you sell the house or you won the lottery or anything. And there's no clear restrictions on the time of it getting paid off. So we want to realize that that option is there. And that option has a value, like all options have a value. So we kind of want to price that into our assumptions of what we should get for a return on this bond. Another thing we want to do is we want to take a look at the bonds, analyzing their yield to the call date. Don't always assume that the bond is going to last until the final maturity date, right? If it's a 6% bond and rates decline, as they have, since 2008, 2009, chances are that bond is going to get called. Chances are. We want to analyze the value of that call option. Yeah, that's a little bit sophisticated. There are a fair amount of assumptions that go in there. But for these purposes, what we want to do is we want to realize that the option is there and the option has a value. And by the way, as the investor, are you buying that option or are you selling that option? Think about that for a minute. We also want to compare that debt to non-callable debt to try to get a sense of the value of that option. The other thing we want to be cognizant of is that bonds priced at high premiums, meaning big prices above par, 105, 108, 110, 110% of par, they tend to be riskier. Now let's go back to that question about the call option and who's the buyer and who's the seller. As the investor, you have granted the issuer the right, but not the obligation, to mature those bonds at par. So you sold that option. So you should get some return for that. That's what I want you to think about. And actually, the less constraints on that option, perhaps the more you should be paid for it. The more constraints on that option, perhaps the less you should be paid for it. Here's another couple of very important risks in the bond market. We've got credit risk and we've got restructuring risk. Right? So what is credit risk? Think about your credit score. It's the borrower's ability to pay the principal and the interest on a timely basis. We call that servicing the debt. Or, if they can't, they will incur a default. We don't really like those. Now, we do have institutions which do an awful lot of research on looking forward on if these companies can pay their interest and principal or service the debt going forward. And we call them credit rating agencies. And they assign a rating to not only a particular company, but a particular bond issue based on that company's likelihood to service the debt. It's important to realize that credit ratings are forward-looking based on historical information. Now, you've probably seen ads for mutual funds and things like that where they say past performance is no guarantee of future returns. That really applies here too. A company's past performance is no guarantee that they're going to be able to service the debt going forward. So credit rating is an ongoing forward-looking process. It's not perfect, certainly better than nothing, and there are some agencies that do a pretty darn good job. No substitute for perhaps doing your own homework, though. Now, if a company's ability to service their debt is adversely affected, a credit rating agency is going to pick up on that. Hopefully they pick up on it early. Sometimes they don't. But when they do pick up on it early or late, the rating that they assign to that company and that bond is going to reflect that adverse occasion. And they're going to lower that bond rating. Well, how do they rate bonds? Well, different companies have different formats. Some say AAA, AA, single A, triple B, double B, and then they go down to C and below. Others use terminology like A1, P1. It's kind of arcane. And it also doesn't really tell you exactly what the likelihood of servicing the debt is. You know what would tell you exactly? Someone saying 99.7% chance of servicing the debt. That would be pretty objective. But the credit rating agencies don't do that. They like to keep it somewhat subjective. It's their industry. We're not here to judge, but we do want to be aware. So if there's an adverse event, their credit rating is going to be lowered. Lowering the credit rating on a particular bond actually is going to have a negative effect on the bond price. If you're going to make a loan to somebody, me for instance, and you think you have a 100% chance of getting your money back, you'll accept a fairly market rate of return. But if you think that there is some chance that I'm going to have a hard time paying the interest or paying all of the principal, well, you might not be willing to accept a market rate of return. You might want a higher rate of return to make up for the probability that I might not pay all the money back. Okay? So when we have this lower credit rating, just like if a person's own credit rating is low, the interest rates associated with that particular bond are not going to be as low as if it had a high credit rating. And that happens even if market interest rates haven't moved at all. So it's a comparative thing, right? How does this particular company and this particular bond rate against market rates in general? Now there are exceptions to the rules, of course. We had some recent downgrades to U.S. Treasury debt. It was big headlines, all the newspapers, CNBC, Bloomberg, all that kind of stuff. People were saying that, oh my gosh, USA debt has always been AAA rated, and now that it's going to be rated AA, the financial system is going to collapse. It didn't. but the rates will go up and it's going to cost the taxpayers more. They didn't. And in fact, the rates fell substantially after that announcement. So that's an exception to the rule. But that's the government. In terms of companies, I wouldn't really say so much that that's an exception to the rule. Now let's look at this idea of default risk. Yeah, that's a little bit more severe than credit risk. So the default risk concerns real changes to that fixed set of cash flows. Remember that fixed set of cash flows that we were so anticipating over 10 years? So the borrower says, yeah, I'm going to have some difficulty keeping up with all those cash flows on time, or the amount, or both. So the default risk concerns the actual changes to the payments and the redemption value, the maturity value, face value, okay, of the bonds, and it can include a total failure to pay them at all. Yeah, that's a lot of tears in that event. So why does this happen? Well, it's a result of the borrower's inability to further service the debt. We could say that's a clinical definition. Doesn't make it any less painful. I want to say that this is a very, very severe type of change. Typically, once a company or a nation makes that type of announcement, they don't go back and fix it. You know, it's kind of a last resort, typically. And sometimes the issuer attempts to renegotiate with investors to preserve some payments. And here are some high-level examples to this. Over the past few years, you've seen the auto industry, right? Auto industry owed a lot of debt, particularly GM and Chrysler were the two big companies involved. And with some jawboning on the part of the federal government and unions and other people, some investors decided, well, yeah, you know, maybe we'll be willing to accept less than 100 cents on the dollar payment at maturity. And this actually happened in Greece as well. Some investors with Greek sovereign bonds decided, well, you know, if we all demand 100 cents on the dollar, there's a good chance that we'll all get 10 or 20. But if we cut back our demands to maybe 70 or 80 cents on the dollar, maybe that's a manageable level of debt for the borrower, in that case Greece, so maybe we'll get that. Nobody was happy about it. And in fact, anecdotally, some institutions purchased insurance against that very act, right? So if I bought a bond issued by Greece and I bought insurance, it said, you know, I'm pretty confident that they're going to pay over time at the time I bought it, but I'm going to buy some insurance just in case. Okay? If that event happens, my insurance policy is going to pay me 100 cents on the dollar. So I'm made whole. If I voluntarily choose to accept 70 cents on the dollar, you know what my insurance company pays me? Nothing. So what's my incentive to take 70 cents on the dollar? As an insured investor, I have no incentive. And this created a lot of controversy among the investors in Greek sovereign debt. You can go back and just Greek sovereign debt crisis, you'll see all these articles pop up. And there was a tremendous amount of political pressure and business pressure on some of these insured investors to say, hey, for the good of everybody, you should really, you know, be willing to lose some money. Well, those investors said, you know, that's not really good for our investors. And that's who they had a fiduciary duty to. You should do that research on your own. It was quite eye-opening. I recommend it highly. But the takeaway here is that restructuring or default risk is very severe, and typically it's a last resort. Now, also, you know, in bonds you have some seniority of who gets what. You know, in the case of default risk, right? More senior secured creditors or lenders, they tend to get the first spoils of money that's left over. Less secured or junior creditors tend to get less money. in the financial crisis with the auto company, auto industry, several other companies, and also with some sovereign nations, the promises or the covenants in those bonds were actually changed around. And that made for an extremely high degree of unpredictability as to who was owed what. And this is really a very, very serious issue. And what happens is that bonds, once that started to happen, bonds really didn't enjoy the same perceived safety as they did previously, because those promises or covenants can change over time. Just a real quick example. I want you to imagine several people lined up, most secure lender, least secure lender, okay? And in the aggregate, they lent $1 million, all right? And the company can't pay back $1 million. They can pay back 800 grand, all right? And let's say that there were 5 of them, 200,000 each, right? Most secured to least secured. Well, the first person, most secured, he's probably going to get 200 grand. The next one might get 190. The next one might get 180. But this last person, they might get 100,000 out of the 200,000. Now, let's think about that in a real return sense. This person who was going to get the first spoils of any money left over in the case of a default, right? They would be willing to accept less of a return. This person who realized that if things go sour, they're going to get the last bit of money left over, well, they're going to demand a pretty high return. I mean, that's fair, right? Makes sense, right? In the restructuring of the bond covenants, what happens is that this person here, the least secured, maybe they get 50 cents on the dollar, maybe they get 70 cents on the dollar. But this person here, the most secured, that was expecting 95 to 100 cents on the dollar, well, now they're getting 70. So it's kind of like they went back in the line several places. And they take a look at their bond prospectus and they say, no, but it says right here. And then the company comes out, probably with Senate and Congress behind them, and says, well, for the good of all, we had to change that contract. And that led to a very high degree of lack of perceived safety and certainty. I don't know that bond markets are going to recover from it. We'll see. We'll see. We like to think that a contract is a contract. What we found is that a contract is a contract until it's not a contract. And that's a little unfortunate. I encourage you to do your own research on that. There's an awful lot of archived articles you can find, New York Times, Wall Street Journal, Barron's, on that particular issue.